Coming up on Market to Market. Closely watched economic reports bring out the bears on Wall Street. Tainted lettuce sickens hundreds of consumers, but authorities aren't disclosing its producer. And in yet another year dominated by unusual weather, hay producers struggle to make a crop. Those stories and market analysis with Jamey Kohake next.
We thought we might have separated ourselves.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, August 2 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The U.S. economy has created an average of 200,000 jobs per month this year, but the brisk pace of hiring in the spring is slowing this summer. The government reported Friday that U.S. employers added 162,000 positions to their payrolls in July, in the weakest month of job creation since March. America's unemployment rate fell to a 4.5-year low of 7.4%. While acknowledging that more workers found jobs, analysts also said the improvement was because others stopped looking for work and therefore were no longer counted as unemployed. The report awakened hibernating bears on Wall Street, where the major indices all declined on the news before paring losses later in the session Friday. One day earlier, the government reported the U.S. economy, as measured by gross domestic product, grew at a lackluster 1.7% annual rate in the second quarter. That was better than a revised 1.1% in the first quarter, but it's still far too slow to make a serious dent in unemployment. And the Federal Reserve said this week it's too early to say when it will begin tapering its monthly purchases of $85 billion worth of bonds, which help keep interest rates low in the hope of stimulating the economy. No one really knows how the markets will react to the end of the Fed stimulus, but the mere suggestion of the taper has been bearish, despite the fact it signals a healthier economy. Uncertainty could be found this week in the produce aisle as well, after an outbreak of foodborne illness was traced to a parasite in lettuce. Bags of salad are at the center of the cyclospora outbreak, according to health officials in a pair of Midwestern states. Health officials in Nebraska and Iowa say they've traced cases to prepackaged salad, but they haven't said which brand or where it was sold, explaining only that most, if not all of the product, was not grown locally. In Iowa, nearly 150 people have been sickened by the bug. Nevertheless, officials say the threat is over and the affected salad is no longer in the food chain. But federal authorities caution it may be too early to say that the threat is over. Nebraska investigators said the salad mix in question included iceberg and romaine lettuce, along with red cabbage and carrots that moved through national distribution chains. The rare parasite cyclospora poses a health threat when humans ingest food or water contaminated with feces. People exposed usually become sick after about a week and have flu-like symptoms that can last anywhere from a few days to a month if left untreated.
Cyclospora is unique in that it's a parasite, and because it exists in this very hardy cyst form, it's much more resistant to washing and routine methods that people may use before consuming their produce.
All told, nearly 400 people in 15 states have been sickened with the lengthy intestinal illness. Food safety advocates say the lack of specifics being released concerns them. They want companies responsible to be held accountable when outbreaks happen. And, they add, customers need the information about where outbreaks originated to make food choices. California provides much of the nation's leafy green produce, and health officials there haven't received any reports of cyclospora. Health officials advise, short of growing your own food, avoiding an outbreak may be problematic. And they say all food, whether local, natural, or organic, has the potential to be exposed to safety hazards on the farm, in transit, or in the store. Late Friday afternoon, the FDA announced the source of the tainted lettuce was Taylor Farms de Mexico. Meanwhile, cooler temperatures and scattered showers delivered much-needed moisture to portions of the Corn Belt this week. Severe thunderstorms roared across northern Nebraska Thursday as winds of up to 100 miles per hour pelted some areas with baseball-sized hail. Portions of Kansas also received more than 5 inches of rain late this week. Regardless of whether any specific area got rain or not, conditions in most regions are much improved from last year, when the worst drought in half a century devastated crops, as well as pasture and rangeland. And as Ashley Davis discovered this week, the variables are different this year, but producers are doing their best to make hay while the sun shines. Paul Yeager explains.
Farmers have endured the ups and downs of Mother Nature this year, with snow in May, planting delays due to wet conditions, and a midsummer dry spell. Corn, beans, and other crops have suffered. Hay producers also struggled this spring due to persistent rain. Dale Leeslian, an auctioneer and manager at the Dyersville Sales Company in Northeast Iowa, has seen a lot of damaged and wet hay come through his auction this summer. With forage coming from all over the Midwest, Washington, Wyoming, and even Canada, Leeslian knows all too well how conditions are affecting this year's hay crop.
The quality is down because last year we had perfect conditions. In a drought year, you can get the hay bale dry, and this year the farmers are struggling to get the hay made properly. And we've had a lot of rain, a lot of untimely rains, and also producers have not been able to cut their hay on a regular 28 or 30-day schedule. They've had to be at the mercy of the weather, so it's affecting quality, and it's going to affect quantity as well.
The sizzling summer of 2012 made for a dry crop season, which wasn't a completely bad thing for hay producers. Demand was high, but the supply was short, which caused prices to skyrocket. This week at the Dyersville Hay Auction, a second crop of mixed orchard grass and alfalfa sold for a top price of $280 per ton.
Sold $180. We had a lot of wet hay. A lot of this big squares was carrying a couple 100 pounds per bale, extra moisture on it, and the shelf life on that hay isn't very long. And we saw the wet hay sell at a deduction today, and the good dry hay sell at a premium.
When it comes to the major crops produced in the United States, hay ranks behind corn and soybeans. But hay is much more labor-intensive. Joel Van Wyk produces corn, soybeans, and hay near Sully, Iowa. Van Wyk believes the market price of hay and the level of difficulty that comes with producing it may be causing some people to switch from hay to row crops.
You know, it's kind of a challenge to put up good hay, but it is not easy. And some years obviously work better than others, but I don't know, it's a challenge.
Despite the hard work, Van Wyk plans to continue growing hay.
There's just not enough hay to meet the demand right now. There's a lot, there's more people that are buying hay than are growing hay.
Second cutting orchard grass alfalfa mix, boys. Good looking hay here.
Due to delays this season, many Midwest hay producers are just on their second cutting. Some are on their third cutting, and as usual, weather conditions continue to be the X factor. According to Leeslian, between April and July of 2012, hay prices shot up 350%, going from $7 per ton to $300 per ton. Weather and the balance of supply and demand will play a big role for hay conditions this summer.
We need a little more wind, and we need some heat again. It's been very cool the last week. The hay's been laying a week now, and when you got record low temperatures, this is October weather. This isn't July weather or early August. We just need a little better weather conditions. And it would be nice if we could get some nice, warm, sunny days and a 10, 15 mile an hour wind and get some very good hay made if we can get about a week without any rain.
For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
Grain prices were mixed this week as strong demand supported wheat, while scattered showers and an improving weather outlook pressured corn. For the week, September wheat recovered most of last week's losses with a gain of 10 cents, while the nearby corn contract moved 16 cents lower. Soybeans, however, revealed the full impact of improving weather as the September contract settled with a weekly loss of 63 cents. Nearby meal prices followed suit, giving up nearly $20 per ton. In the softs, cotton traded in a sideways fashion as the December contract shed 14 cents per hundredweight. In the dairy market, September Class 3 milk declined by 15 cents, while the October contract was unchanged. Over in livestock, October cattle lost $1.38, nearby feeders advanced by $1, and the October lean hog contract posted a weekly loss of 85 cents. In the financials, the euro gained 9 basis points against the dollar. Crude oil advanced by $2.25 per barrel. COMEX gold declined by $11 per ounce, and the Goldman Sachs Commodity Index gained more than 5 points to settle at 642.65. Here now to lend us his insight on these and other trends is one of our regular market analysts, Jamey Kohake. Jamey, welcome back.
Thank you, Mike.
Let's get right into this week. As we take a look at the wheat market, we did see a nice rebound this week. What was driving that? Primarily export news?
The demand market is good right now for the wheat sector. There is also a lot of spread action versus corn, long wheat, short corn. That moved to new highs for this move this week as well. But the bigger story in wheat has been with China. They've lost somewhere around roughly 20% of their crop. So there's all these expectations, forecasting going on that China will be a big importer of wheat. Also, the seasonals have turned a little bit more bullish as well. We're pretty much done with the hard red winter harvest, and seasonally we start to see a rebound then. But if I was going to pick one grain to get long on, it would be wheat based off of demand. The wild card is going to be the U.S. dollar. You saw an uptick there midweek. I don't think the dollar hangs on long term, but it is something to watch out for. But I do like buying wheat on breaks, and I would buy the 660 mark off the December Chicago contract.
And hold for what sort of a high end do you see in the wheat market?
I think 7 would be pushing it right now just because there's a lot of weakness in the other grain pits, and I think it would be hard to really sustain a rally on wheat on its own right now.
But it'd be wise to get in there on a break, sell off when we get a rally, starts to get a little toppy.
Yeah, but watch demand. It's all demand right now, and the long-term picture does look pretty supportive.
Now, when will we start seeing purchases from China to fulfill their 20% that they're down?
I think it'll start here soon, continue all the way through winter. And it's a longer-term picture, and it's a bullish picture long-term. And get the dollar to weaken up as well, too. Increase some new demand out of Egypt as well, and we could really have a nice wheat market, this winter again.
And things will have turned around from this last year when exports were a little light.
Exports were light, and we didn't attract any business at all worldwide.
All right, well, maybe we'll see a change there. Now, as we take a look at the corn market, we did see corn continue the sell-off this week, again, primarily driven by weather.
Yeah, it's the same old news, pretty much with corn and with beans. No threatening weather at all in the forecast. No reasons pretty much at all for the funds to start to cover their shorts. Funds are short roughly 120,000 contracts right now. And without a reason why, for new catalysts to get out, the trend remains down. We do have a decent-sized report coming out in 10 days. I'm expecting a little bit of short covering late next week, maybe push it back to the 480s, 490 area. But the rallies right now are going to be short-lived. It's all going to be short covering. I don't see a whole lot of new money coming in right now. I think it's probably early fall when that happens, when we know more about acres, we know more about crop size. But the market looks to be right now just wanting to stretch the rubber band as far as possible and see what happens. And it looks like we're heading to 450 here soon.
450. So now, from the producer's perspective, maybe they haven't sold all the bushels they were hoping to market this summer. Best bet just to wait. I mean, do you think we'll end up seeing 450 as a floor? Might see a rebound depending on harvest? Or
yeah, I think we could be October time period. I think when that would start, when we have some more factual basis or better picture of do we have a 14 or 15 billion crop size. I think we're about a 13.7, 13.9 right now. But we need more, I think, before the bulls come back out and try to push this thing higher. But for producers, look at the March. There is a little bit of carry out into March. If we can get a short-term bounce up to $5 in that, I would take a short-term sell there as well. Also, watch the red December 15 contract if you're a producer. Get back up, that 5.10 mark. I would take a sell there. We broke the $5 mark here this week in the D15, so it needs to be watched as well real closely.
Now, as you mentioned, we got the report on the 12th of this month. Any advice for producers as we get into that, since it probably will be another risky report?
It'll be a market mover as usual. I would hold shorts. I don't like, selling 460 right off the bat come Sunday night or Monday. If that is the case, I would, maybe hold off till mid to late week, see if we can get some profit taking coming into the report and try to lay some more off then. But the market is oversold. The trend is down. There's nothing in the forecast, to change the short-term picture right now. But I would hold off chasing this thing lower just based off technicals.
Okay. All right. Now, as we take a look at soybeans, we've lost $1.10 on the board in the past 2 weeks. Is this a downturn that can we see the bottom from where we're at today, do you think?
Well, it was an ugly trade today, technically. We broke the spring lows, 1185, and triggered some stops. Not a ton of stops, but did trigger that. It's the same picture here as in corn, just nothing on the horizon weather-wise to attract any fresh money. And I think we'll get back to $12. A guy could sell into that here short term. But it's the same thing with corn. A lot of uncertainty. I think we're going to get a decent play off beans with the acreage number being readjusted that we'll see in 10 days. But here right now, we stay below 85. Technicals are bearish, and it looks like we could be pushing towards 1140. That's the double bottom low back in June of 2012. So that could be, the longer-term extension down to. But beans are obviously an August crop. A lot of uncertainty yet, so we could see, 1240 area to sell back into. But we need a catalyst. We need some weather, or the trend is down here with the corn market.
All right. Now, as we look at the demand picture for soybeans, we've talked about there's been a good story behind beans all year. What are you seeing demand-wise, particularly from China and Asia at large? Does demand look strong for the rest of this year?
It looks steady. China has been buying. I think they will buy more here on this break that we have seen. Same way with the corn. I think we will attract fresh export business down here at these levels. But the problem is there's just no new money coming in. It's sidelined. It's a low volume trade here the last few days at times, and there's just nothing new at all to attract any short covering. The export business is mostly routine, and the weather just has most of the money scared right now and sidelined, or you're short, and it's just kind of a lackluster. Trend is down and get out of the way pretty much.
Right. And we're looking cool and wet for the foreseeable future on the most recent forecast. Is that what you've seen?
10 to 15 day is below normal temps, normal rain. So yeah, there's not anything out there besides this coming report a week from Monday, that could shake the market up. The market is oversold, and it would be a prime time to really start to flush some shorts out if there is a bullish number there.
All right. Now, one of the things, has the trade started to consider the threat of an early frost? I've heard producers talking about that recently. Is that starting to weigh on the market's mind at all?
It has not yet. I think that'll come Labor Day time period when, guys might want to start to buy some calls, lighten up on some shorts maybe, depending on what the forecast does look like. The crop is obviously late, especially the corn. So yeah, there is time out there to be able to get a fall rally yet off of weather.
But knowing that there's not, for producers, again, same question as in corn, maybe they don't have all the beans they'd like marketed, knowing that 1140 could be the next technical bottom, would this be a selling opportunity?
I think if you push back towards 12 area, I would do something there. I think beans have more time, than corn to really get nervous about. See, a new forecast next 3 or 4 days if there is any heat at all in the picture. Funds are still long beans, and so I think they will defend their positions a little bit better than what is going on in the corn market right now.
All right. Well, now let's take a look at the livestock market. We did see live cattle sell off a little bit this week on the mercantile exchange, and we've still seen the cash market holding steady at about 119. What does the future look like for fat cattle?
Yeah, the 119 trade this week was disappointing. The asking prices up around $1.22 early on. The 119 did pull some money back out of the market. Show lists were big. Weights are up 4 pounds compared to last week, 7 pounds compared to a year ago. And a year ago, the weights were a record. And so all of that kind of overhanging the market. Boxes, too, are back to where they were back in February. And so that all kind of weighed on the market. The market did get a little bit oversold. We did see a little bit of technical bounce late in the week. I don't see cattle doing a whole lot right now short term. I think we're range bound 124, 126 for the October contract. We bounce back and forth in there. Longer term, a little more bullish, but here's short term, I just don't see a whole lot happening.
Just not a lot of upside, and there's no real event on the horizon that could spark us to get a new surge in demand, is there? I mean, there's nothing out there that the trade's watching to see if we can get these prices juiced.
We could get some, maybe a little bit more demand from Asia, Japan, something like that. But right now, I think the more excitement is obviously in the feeder pits. They've been on a $10 rally. And so the money a little bit has flowed over into there. But the cash market mainly just being steady. I don't see a whole lot happening right now in the cattle. Longer term, I'm still bullish.
All right. Now, you mentioned feeders. Let's talk about that, because feeders have been a compelling story for the past 6 weeks, really.
Yeah.
Feeders have been on a tear.
Even the last 3 months.
Yeah. Where do you see that headed?
Longer term, I'm still bullish feeders. I would not get long up in here. I'd like to see November pull back around 155, 160, 155, 60, 156 area to get long. But I think this is a longer term bullish story. We've had some decent rains down in northern Texas, last 30, 45 days. They've been replenished in a lot of that area. And corn market, obviously, being the big factor of tanking there. But I like the feeders. I would buy breaks here short term. And now,
if this corn market does continue to fall, if we get down into the ranges you talked about, that 450 range, even sub that, how much upside does that give the feeder market, knowing that cash fats are still at around 119?
Yeah, I think the talk will be back to where we were before. There'll be 160s running around in the newsletters and talk all over. But I think we'll need some demand to sustain it. But look to get long on a pullback. I don't like buying up here at 158, 159 area.
All right, just let it buy on a break as we get down, as you mentioned, 156, 155, 60, down in that neck of the woods. All right, now as we take a look at the hog market, that's another market that has been on a pretty nice run here the last couple months. This week we saw a pullback. Where do you see hogs headed? Have we topped out on the hog market?
I'm a little bit bearish on the hogs. I like selling the October up around 85.90. That's one of my more favorite trades right now. I don't see the cash market hanging in longer term. We'd have a decent trade this week at times. Cash looks to be mostly steady starting out next week. But I don't think this cash holds in here longer term. I'd look to be selling rallies. One thing a hog producer does need to look out for are these deferred contracts out in the first and second quarter of next year. There's a lot of expansion talk with this cheaper corn market. So don't fall asleep and just trade nearbys. Watch these fall spring contracts.
Know your margins, and if you can lock in a profit that far in advance, take advantage of it.
Take advantage of it, and don't let this slip by out of here with this corn market being shaky here probably for another 3 or 4 weeks.
Now, how low do you see hogs getting, looking at the supply demand scenarios out there? What have you heard?
I could see October slipping down around 80, 81 area. I know this is a big move, but a little bit bearish out into the nearby hogs here short term. There's been some talk out of Chicago, talking in the 70s. I'm not that bearish yet. I like to see grain prices and the demand here this fall, but selling rallies I think is a good idea here in the hog short term.
Take advantage of it. Mm-hmm. Now let's talk a little bit about the dairy market. We've been again range bound as we look at milk prices. Where do you think milk is headed?
I'm a little bit bearish here too, Mike. I like October milk up around 18.90. That's roughly the 100-day moving average, 18.80 area, and I sell into that. We saw the June milk report this week. It was bearish, but it looked to be factored into the market. So I would kind of toss that out the window right now and just go back to selling rallies here short term.
Sell the rallies and be prepared, as you were saying earlier.
Yeah. Mm-hmm.
All right. Well, thank you so much for being with us, Jamey. Really appreciate you taking the time. That wraps up this edition of Market to Market. But we'll continue the discussion online and answer some of your questions in our Market Plus segment on our website. You'll find audio podcasts and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us again next week when we'll examine the government's latest numbers on agricultural trade. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.